Okay, we are joined here today by founder and CEO of Dydx, protocol on Ethereum for spot trading, margin trading, and now perpetual contract trading. Welcome, Antonio. Thanks for joining us.
Yeah, thanks so much for having me.
Great. So, just to give listeners then a introduction and background, can you tell us about the Dydx team? Like how many members are currently working on the project, and what jurisdiction is it based out of, and stuff like that?
Yeah, absolutely. So DYDX has been around for a little over 2.5 years now. Our team is currently 9 people, with 7 engineers, including myself, and then a product designer, and then one person in operations. We're currently operating out of the US, so we're based in San Francisco. So yeah, based out of here. And DYDX has raised 2 rounds of funding to this point. So we've raised a total of $12 million from Andreessen Horowitz, Polychain Capital, and a couple of other really good investors.
Okay, and you guys, just so people understand, you're building on Ethereum, and these markets that you're running are meant to be decentralized and trading Ethereum-based assets to be decentralized.
Yeah, absolutely. So what we're building is all based on smart contracts that do, in fact, run on the Ethereum blockchain, as you were saying. So up until this past week, we were pretty limited to only trading Ethereum-based assets, so like ETH and ERC20 tokens, through our spot and margin protocol. But just this past week, as we're about to talk about, we launched a perpetual contract market, which kind of enables us to synthetically trade assets that exist not just on Ethereum. And the first one we launched there was the BTC perpetual contract. So we're pretty excited about that, as it obviously allows us to trade many more types of cryptocurrencies than just the ones that exist on top of Ethereum.
Definitely, and we'll talk more about that in some detail. I just want to provide everyone with a bit more context. So everything's happening on Ethereum, and up until now, you've offered just spot and margin. Can you tell people how the system works for spot and how the borrowing and trading works on the margin product you've offered, not the perpetual futures, but before that?
Sure thing. So yeah, our margin product has been live for a little over a year now. And kind of the way it works is it all works through on-chain borrowing and lending. It works through a pool-based lending model, so similar to Compound, if any of you guys are familiar with that. But basically, there's pools of lenders and borrowers for each particular asset. The 3 assets we currently list on the margin product are ETH, and then USDC, and then DAI, the decentralized stablecoin. And basically, there's a dynamic interest rate, which is kind of based on the volume or kind of the interest in borrowing each particular asset, and also how much supply there is for that asset. So kind of as the ratio of demand to supply increases, then the interest rate increases, and as it decreases, then the interest rate decreases. And we basically use these lending pools, which are, again, kind of set up similarly to the pool-based model introduced by Compound. But kind of the main way we do it differently is we natively build in margin trading. So we kind of have built our entirely own trading protocol, something similar to 0x, which basically functions with off-chain signed orders. For those of you who aren't familiar, basically how trading works on DYDX and a couple of other decentralized exchanges is that whenever you make a trade on DYDX, you basically sign a message, cryptographically sign it, saying what assets you want to trade, how much, and at what price, and a couple of other pieces of information. Then you sign that with your cryptocurrency wallet, and then send it to our smart contracts. And then our smart contracts effectively know how to execute those trades, know how to check the signature to make sure it was in fact you who placed this order. Then if everything looks good, then kind of the trades will be executed directly on our smart contracts like that. But we've kind of found that having this lending protocol combined with the trading is a really powerful thing, and kind of natively allows us to offer margin trading, which has been a pretty big use case for DeFi trading to this point.
So most of the traders here and those that are listening are used to a centralized experience, which is obviously very low latency, People are able to jump in and out really quickly with orders, creating and canceling, and managing open positions. Can you explain how your decentralized approach, which does a lot of signatures and pushing some stuff to the chain, how do you balance user experience with maintaining a decentralized principle within the market?
Yeah, absolutely. That's a great question. So DYDX takes a bit of a hybrid approach when it comes to decentralization. So as I was just mentioning, basically all of the orders and all of the trading that you do on DYDX is kind of authenticated by these cryptographic signatures. But the only thing that ever gets pushed on chain is the actual fill transactions. So only if you get matched with another order and then you actually trade with them will that get pushed on chain. All of the other stuff just happens directly on our backend servers. So it's as performant and as low latency as you would find on any other exchange. So like placing a limit order, canceling a limit order, understanding when your trade has been filled, at what price. So kind of you'll know when you make a trade on DYDX immediately what price it's getting filled at. And then kind of you just have to wait for the transaction to get mined on the blockchain in order for it to settle. But effectively, the user experience on DYDX is very similar and as performant as just using a centralized exchange. And that's really what we're going for. We really want to make a product that's accessible to people who aren't necessarily as familiar with using decentralized applications and a lot of the weird quirks that some other decentralized financial protocols have.
Okay, let's talk about the UX of how this hybrid model works. So basically, if I want to trade on DYDX, what do I have to do on chain before I can create orders? At least with the margin and spot side, because I guess maybe it's performing a little bit differently on the perpetual contract than it is on the other two products, or
Yeah, absolutely. So I can just walk through an example of basically how you open up the DYDX site and then all the different things you'll have to do and kind of how they work until you make your first trade. And it's quite similar for the margin product and the perpetual product. They both work in a very similar way.
okay.
So if you go to our application, you'll open it up. Let's assume you already have a cryptocurrency wallet. If you don't, kind of the first step would be getting your own wallet, getting some funds in it. And then kind of the first thing you'll have to do is deposit funds into the protocol. So this is very similar to just depositing on any normal exchange, just kind of sending a transaction to the blockchain to deposit your funds onto the exchange. Should be pretty simple. Then kind of after that, the only other thing you'll have to do is you can basically immediately start trading. There's no concept of an account on DYDX, so you don't have to sign up with like a username and password. Don't have to worry about 2FA, don't have to do KYC, anything like that. You can kind of just walk up with your wallet and pretty much immediately start trading after you've deposited. So now you have deposited some funds into the platform. Then you can go on the exchange and start placing orders. So let's say you want to place a limit order. You want to sell Ethereum for USDC at like 200 USDC per Ethereum. So you put all those details in on kind of our trading page, very similar to how you would do it on any other exchange. You click the place order button. And then kind of the unique thing that happens is the authentication is effectively done by your wallet. So it'll pop up a notification in your wallet application. We support a bunch of different wallets, but let's say you're using MetaMask, which is a popular Ethereum wallet for interacting with UIDX. So the MetaMask pop-up comes up. It'll ask you to sign a message. And this thing that you're signing is kind of the order that I've been talking about. It fields like what assets you're trading, what price you're trading at. So if it all looks good, you'll basically sign it in your wallet. And then effectively, that's it. That's all you have to do. And then what kind of happens in the background is that signed message gets passed back to our servers, which are basically running our centralized matching engine. And then we'll try to match your order and kind of see if it matches with, say, if you're selling Ethereum, we'll match you with some buy orders for people who are trying to buy Ethereum. Very simple, and it's kind of the same order book approach that you would experience on any other exchange. So let's say your order doesn't match with anybody. So then it would just kind of sit on our order books, would wait to be filled by somebody else who kind of would want to take the price that you're offering. You can cancel it at any time. Cancellations are also free and instant. So cancellations very similar to placing an order. You just effectively sign a message saying, I want to cancel this order. It gets put to our backend, and then the order is immediately canceled. Let's say somebody eventually fills your order. So this kind of order has been sitting on our books. Eventually somebody wants to come and buy the Ethereum that you're offering to sell at 200 USDC. So our matching engine will place this fill transaction with kind of the trader that you were matched with. And then it'll send a transaction to the Ethereum blockchain. It'll send a transaction to our smart contracts, which for those of you who aren't familiar, are basically just programs that are running on the blockchain. And then our smart contracts will verify the signatures of all the orders. And if everything checks out, they'll just transfer the funds between all the different accounts that are trading on Dydx. So basically the UX is very similar to what you'll experience on a centralized exchange. The two different pieces that are slightly different are when you're placing trades, you need to authenticate every one basically. So that's kind of the magic of decentralization. Like we can't do anything without you authorizing it first. So you'll have to basically just sign orders in your wallet. And then kind of the only other difference is every time you get matched with another trader, we'll send a fill transaction to the blockchain, which will eventually settle kind of at the price that we've told you.
Okay, so there's a lot there to sort of unpack for people that are newer to DEXs or to smart contracts. So let's start from the top where there's one on-chain transaction when you're depositing, which goes into a smart contract. So just so people understand, who then has custody of those funds once they're sitting in the smart contract? Do I still retain custody even though they're sitting in the smart contract?
Yes, that's a great question. So you as the user do in fact retain full custody funds while they're sitting on Dydx. So functionally, your funds won't be in your wallet anymore. So if you go on like Etherscan or whatever block explorer you're used to using, they won't show up in your account anymore, but they will show up in your account on Dydx. And effectively, the way smart contracts work, one really interesting feature of smart contracts is they can quite literally hold funds. So kind of say you deposit ETH, the ETH that you deposit will be held in our smart contract. And then our smart contract will only allow your private key or your wallet to be the one to withdraw your funds, to do trades with your funds, to basically affect your funds in any way.
So once I've deposited these funds into the smart contract, I still retain custody. And then the reason why every order that I make as a user, I have to sign it. Does that then lead the smart contract to validate the removal of funds because I've signed an order to give instructions to do so?
Yeah, that's exactly correct. That's basically how the smart contract knows that you are the one that authorized these funds to be traded in a specific way.
And so all of that smart contract code on Ethereum is completely open source. So everybody can verify the logic that the smart contract's using to, once it receives funds, how it's actually releasing funds, either to allow for a fill or whatnot. All of that is open source, so everyone can see it, right?
Yep, it's all open source, so all available on our GitHub page. You can go and check out the code if you don't feel like doing it. We've basically also gone through a number of independent third-party security audits. So one really popular thing for decentralized protocols to do, which you should really validate before you use any decentralized protocols, is that the protocol has independent third-party security audits from a really reputable firm. Our contracts have all been audited by OpenZeppelin, which in my opinion is the top security firm, but would encourage everyone to do their own research on this. But yeah, everything's open source. You can kind of validate that the only way your funds are going to be moved are kind of in the way that the smart contract allows.
All right, and is there any, because when I was testing it out, there was also a step before depositing where I had to do an approve transaction. Can you explain what that is?
Yeah, absolutely. That's a great question. I did gloss over that a little bit for conciseness. But yes, you're correct. So basically the way depositing works on Dydx is there's actually two different stages to depositing. And you're right, you basically, the very first time you use the application, you'll have to effectively approve the application to pull funds from your wallet into the smart contract. And on Ethereum, that's effectively how, like any random smart contract can't just walk up and start pulling funds from your wallet, of course, because then anybody could steal your funds. So you effectively have to set allowances or kind of approve various smart contracts that you want to use to interface with your Ethereum account. So that's the very first transaction that you have to send, but you only have to send that transaction once. That transaction, all it does is allow the contract to pull funds from your account, but still the contract can only pull funds from your account whenever you send a transaction to it or when you send a signed order or something like that. So the second transaction is the actual deposit transaction. So you can choose how much you want to deposit exactly, but you're right, there is kind of an additional first step. You're effectively just setting allowance or approving the smart contract to interact with your funds in your wallet.
Okay, and so just because I approve it, it doesn't mean that the smart contract can start ripping money out of the account. I have to still approve it either through sending the deposit on chain to it or through the signing of the orders, which still, if I sign something, they can still only come out of the funds I've actually deposited.
Yep, that's correct. The smart contract can't do anything unless you sign an order or send a transaction to it saying exactly what you want to do.
Okay, and so then once you've approved and then deposited, you've got funds sitting in the system. And then every time you're saying that there is a creation of an order, I have to actually sign this request. Is that true?
Yes, that's correct.
Is that also on the cancellation? I can't remember.
Yes, that's also true for the cancellations, but the cancellations don't have to be published on chain, so they're instant. So the signature there is just to effectively validate to our backend that you were the one who in fact canceled this order.
Right. And then I noticed when I was looking at the order books of some of the products, a bunch of the liquidity was sort of, it looked like it was being programmatically provided. Like there was someone that was using maybe an API to automatically provide liquidity. And to me, it would be surprising if they were doing this and then having to click to sign every time. But I guess they could programmatically be signing every order that they're sending. Is that what's happening?
Yeah, that's exactly what's happening. So we have a lot of programmatic traders that kind of trade on Dydx, and it's actually a really easy experience and something that's pretty similar to programmatically trading on any centralized exchange that traders are used to. So effectively, you're right. Basically, what they're doing is they load their private key onto whatever trading bot that they're using, and then they'll use that to automatically sign every single trade they want to make on the system.
So I guess so for me, who was just trying the system out as a point and click trader, I found this to be a source of like friction for me to have to sign every time I was creating, sign every time I'm canceling. That was a bit annoying. And if I was, and a lot of the people in Whalepool are API traders, and I think it would be suboptimal to have to load your private key into a server that you are running a bot on. Like normally they'll generate an API key which has limited permissions. So if that key were to be compromised, they wouldn't be able to just withdraw everything, whoever's the attacker. So loading the private key on a server, which essentially exposes your private key to the internet, which is usually not a good idea. This also is, for both the point and click trader and the API trader, it seems like this signing requirement is a bit of a friction.
Yeah, that's a good point. I would argue that loading the private key onto a trading bot is fairly similar to loading an API key onto your trading instance, assuming that, say, you just use a totally isolated account for trading on Dydx, and then you're not holding any other non-UIDX funds in this account, which I would say is good practice. For the trading bot, yeah, definitely you can kind of use the private key to effectively sign whatever you want. Typically isolate the private key to a separate service, which only allow, and kind of the other service would only allow you to sign UIDX trades, let's say. It wouldn't allow you to actually withdraw. So it's permissioned fairly similarly to kind of the way that API keys work on most centralized exchanges. And then, yeah, definitely we're working on improving kind of the wallet point and click experience for non-programmatic traders. I would say that right now, kind of Ethereum wallets are in pretty early stages. We're interested in kind of integrating more directly with wallets, or kind of interested in providing potentially like Dydx native wallet options, which wouldn't require you to manually sign every single order. Maybe you would just like authenticate Dydx one time, but definitely realize that that's a small point of friction for users and something we're working to improve.
Yeah, and I mean, a lot of traders some traders are doing thousands of trades or thousands of orders at least, where they're creating and canceling nonstop on a volatile day, and that extra signature click. Like I was using MetaMask just to play with it, and you have to wait for MetaMask to load up the screen, and then it's a few seconds, which adds up when you're doing a lot of that activity. But I guess the way you describe the programmatic use, it could be used as long as so you can expose a key that doesn't necessarily have access to any funds and is only used to sign the transactions without actually having access to funds. Did I hear that correctly?
I was saying that you could basically architect a system that would trade in that way. So say you had two separate services, one service which held your private key, and all that service let you do is sign UIDX trades, potentially within certain parameters. And then you could isolate security to that particular service. Then you could have a separate service which has all of your trading logic, which would kind of interact with the first service and could kind of get around, or could basically isolate the security to one smaller and simpler part of the service in that way.
So you're thinking more as a like server architecture type setup, not that the keys can be permissioned based on the setup. And you're like, because what if your whole system got rooted, and it doesn't matter if it's on different services, that the guy who roots you can just scrape through everything, and they still got your key.
Yeah, that's correct. But probably your centralized centralized exchange trading bot getting rooted would be a pretty bad experience too, if the attacker could effectively force you into any trades that they kind of wanted to, even if the API key only had trading permissions. But certainly it's a valid point, and kind of take that. It's certainly something you have to think about when you're interacting with any decentralized exchange where you're custodying your own funds, is kind of the security of your private key.
Yeah, I think I think that it's definitely better to have a permissioned key which is limited only to trading, so that in the worst case, then all they can do is really screw around by doing bad orders. But with a key that also has access to the funds, which would be the case for Dydx, then it's a bit worse of a situation if you're compromised. So I don't know if you can somehow architect the system so that you have like a separate key that only is able to do signing, so that way anyone who's programmatically trading is limiting their exposure more on the level of what someone would expect on a centralized exchange.
Yeah, that's a great suggestion. We don't currently have that, but certainly something we can think about adding in the future. There's a lot of interesting things you can kind of do with cryptography to allow you to isolate kind of permissions like that, but something we don't currently have.
Okay, so then we're at the point now where you're signing in order to create orders, signing to cancel orders. Now let's say that you've signed to create an order and you actually get filled. This is the point you're saying where there is now on-chain activity. The centralized server checks the signatures, makes sure that the orders are there so there's no fraud occurring, and then the centralized server fills the order and pushes it to the chain, which then results in deducting and crediting the funds as per the trade instructions. Is that correct?
Yeah, that's exactly correct. Yep, that's right.
So your centralized server is pushing the trade and on chain, and so you're paying for the on chain fees for this transaction, right?
Yeah, that's correct. So we centralized UIDX are paying for all the gas fees for trades on the system at this point. So when you're trading on DYDX, you don't have to worry about whatever gas fees kind of the fill transaction would have to pay.
Okay, and I guess recently the network congestion has been a bit high, so the fees are a bit out of the ordinary. Because when I was testing it out, I noticed that I didn't know if the transactions that I was doing were just abnormally large, and then I saw, and other people were also mentioning to me that I think the gas fee for safe slow was something like 50 Gwei, which is rather high.
Yeah, that's correct. In the past month or so, and especially in the past week or two, the gas fees have been quite high on Ethereum. So normally I would say they're about like 5 GWei. And then as you mentioned, they were kind of spiking up to like 50 in the past week. So it's kind of 10x. So definitely a big consideration, and gas fees are something we definitely have to think about.
So you're paying for the gas fees for the fills, which get pushed to the chain. We, the trader, are paying for the approval and the deposit, and then, of course, the withdrawal afterwards, which we'll get to. What about what's your business model then? So you're paying for the central server, you're paying for the on-chain fill transactions. What is it that you're making on the revenue side of things?
Yeah, so very similar to any other exchange you're likely to trade on, Dydx charges trading fees. Our fee model on the margin product is currently 15 bips taker, and then 0 bips maker. And then on the perpetual product, our fees are 7.5 bips taker, and then negative 2.5 bips maker, so a refund on the maker side. One limitation of trading on Dydx, as I think you're kind of alluding to, is definitely it makes sense, for us and kind of for the entire system to be trading larger amounts of funds at a time, because effectively the transaction fees that you're paying, anytime you deposit as a user, or for us on the trading side, anytime we execute a trade, are basically a flat fee. Kind of the amount fees are basically based on the amount of computation that the blockchain has to do. So the blockchain doesn't care if you're trading like 1 Ethereum or 1,000 Ethereum, kind of the fees will be the same. So kind of it definitely makes a lot more sense for us to try to cater towards larger traders and try to get those executed on the system. And consequently, we do have one other interesting fee model, which is basically if you're trading below a certain amount of funds, which I believe is set at 5 Ethereum right now, so about $1,000. Then the taker fees are 50 bips on both the perpetual and the margin product.
So there's a small order fee on the perpetual margin products. On the margin, and this is only for the taker side, not the maker, right?
Yes, that's correct. Only on the taker side.
Okay, and I guess that's because you rely on the liquidity providers to provide pretty thick liquidity. So then it's on the takers who, if they want to go small, then they'll pay a higher fee in order to go small. What about the margin? Before we get to the perpetual, because I think people want to hear definitely about the new perpetual product. I just wanted to give everyone like a perfect context of how everything works. So on the margin product, you're actually borrowing funds via smart contract. And I noticed I was playing with it a little bit, and the transaction's pretty large, or relatively large, I would say. It was something like maybe 3 times as large as the deposit transaction. I don't know, again, if this was a function more of the network congestion or if those transactions are a bit larger than normal. But can you put that in perspective, how the borrowing? Because if I'm then depositing and then I have to borrow, and that's one transaction, then I have to repay, which is presumably another transaction, and then there's interest that I have to pay. Can you put this into some context about how much of this is going on chain and how many different transactions all that is?
Yeah, absolutely. So maybe let's just kind of break up the different things you can do on Dydx. So as we've talked about depositing, you would pay the transaction fees for that. You would send a transaction. Making trades, so this includes both margin trades and trades on the perpetual, you don't have to pay the transaction fees for, even if you're trading on margin. So kind of say you're margin trading, you've deposited 1 Ethereum, you want to go leverage long. So you'll say you'll borrow some DAI to be able to do that. Kind of the borrowing of the DAI and the trading for more Ethereum all happen at the same time and automatically. So you don't have to pay transaction fees every time you're doing a borrow because of a margin trade. So I think what you're talking about is another feature that Dydx offers is the ability to borrow funds directly to your wallet. And then you can take those funds and do whatever you want with them. And similarly, you can repay these funds. You can basically do whatever you want with them. So the borrow transactions definitely, yeah, they're a little bit more complicated than kind of the deposit transactions. So they'll kind of be a higher multiplier on the gas price that you're setting. And this is kind of just because of what I was saying before. Like effectively the transaction fees that you have to pay are proportional to how complex, and compute, like how much programmatic operations the smart contract has to do to execute your transaction. And definitely doing the borrows are, I would say, a little bit more expensive than doing the deposit. I'm not sure exactly how much, but probably like 2x as much. Would definitely say that kind of while you were using the product was an abnormally high gas price time. So certainly the gas fees will be high there. But yes, for basically the things that you have to pay gas fees on as a DYDX user are deposits, withdrawals, and then borrows to your wallet, and then repaying the borrows from your wallet. And those are the only things that you have to pay gas for, in addition to like approving the contract for the very first time.
So how does and just to be clear, did you say that the borrowing is a separate thing than doing margin trading, where the borrow is collateralized by a position, or are these tied together?
So yeah, it uses the same system. Either way, you're effectively borrowing from the same pool, whether you're doing margin trading or whether you're doing just borrowing directly to your wallet. While you're doing margin trading, basically what you're doing is, say, let's just walk through like a really concrete example of going leverage long Ethereum on the platform. So you walk up to the platform, you deposit 1 Ethereum, then say you want to borrow 100 DAI to buy even more Ethereum and go leverage long ETH. So you'll deposit onto the platform, you'll make a trade by signing an order. When that order is executed by our backend, kind of the transaction is sent to the blockchain, 100 DAI will be borrowed from the pool and will be used to buy even more Ethereum from somebody else who's offering to sell that to you. But in this example, you're just keeping all of the funds on the platform, so they're not really going anywhere. Alternatively, let's say you want to walk up to the platform and you want to deposit 1 ETH as collateral, and then you just want to borrow 100 DAI directly to your wallet. So you want to use that on a centralized exchange, like really whatever you want to do with it. So very similarly, you'll walk up to the exchange, deposit your 1 ETH, for which you'll pay transaction fees. This time, you won't sign anything. You'll basically just send a transaction to the blockchain, which you'll pay gas fees. And then those DAI will be transferred directly to your wallet instead of being used in our previous example to buy even more Ethereum on the DYDX platform.
Okay, so in the margin situation, you're sort of combining them into one transaction, so it's a bit more efficient?
Yeah, that's exactly correct, basically.
Okay, and what about the interest payments that are associated with the borrow? Presumably it's like an open-ended loan where the borrower is in control about when the loan is terminated. So assume that I'm, for example, in a large position, or a position on ETH, and I have to pay an interest rate every, I don't know, is it every day or so that the interest is deducted?
So interest on DYDX, both for our funding rate on the Perpetual product, which we'll get to, but also just on the margin product on specific assets, is paid continuously. It's not paid just kind of like quantized like every day. So what continuously paid is every single block on Ethereum, you'll kind of accrue the amount of interest that you need to pay or earn on your assets for that specific block. One interesting property of DYDX is obviously you'll be paying interest on all of the funds that you're borrowing, but additionally for the margin in spot products, you'll basically also earn interest on your collateral for the entire time that they're sitting there. So say you've deposited ETH and you're using that as collateral, you'll be earning interest on your ETH and you'll be paying interest on whatever you're borrowing, let's say USDC or DAI. And as I was saying, the interest accrues every block. So effectively, an Ethereum block is like once every 15 seconds. So you can effectively conceptualize it as the interest is being paid or earned continuously.
Okay, that's an interesting property you mentioned before. So if I'm pledging a certain asset in collateral, I'm actually earning an interest rate on that as well. So who's paying that rate?
So who's paying that rate is people that are borrowing that asset. And this kind of gets back to kind of the initial premise of how our lending protocol is set up in that it's pool-based lending. So kind of you're not just borrowing or lending from one specific user on DYDX. You're kind of borrowing or lending to this big pool of assets for each specific asset. So say you've deposited ETH as collateral, that's being put in the ETH like borrowing and lending pool. And then kind of the interest that's being accrued on this pool is from people that are borrowing ETH. So say they're shorting Ethereum or whatever else they're borrowing ETH for. And then those are the people that are paying interest to the pool. And then you have effectively some share in the pool from what you've deposited in terms of your ETH, and you're earning interest based off of that.
Okay, so it's not being like rehypothecated, right? Because if I'm putting ETH down and borrowing DAI, that ETH should be basically, or conceptually at least, I would think it would need to be dedicated to backing that DAI loan, so that the person who lent it to me is secured in his loan. But you're saying that it actually is also being lent through this pool, so it can also be active in that sense. How do you do that without hypothecating the collateral?
Yeah, so basically all the borrowing and all the lending is done through these pools. And effectively, we can consider the system to be collateralized, since everybody's borrowing and lending in the same way, so long as every individual account is fully collateralized. And we have certain liquidation mechanisms that basically enforce this. But say you're borrowing from the DAI pool and lending to the ETH pool. So you're not like borrowing DAI from one specific person, as I've been mentioning. You're just borrowing from this DAI pool. And as long as that system is kind of fully collateralized by all the other collateral that's on the system, then everything effectively works out. And as I was saying, this is kind of a very popular lending model, not just for Dydx, but for lots of different systems, especially across DeFi. So this is basically how Compound works, Compound Finance, a couple of other really good lending pools, like there's one called Aave, and all of them work in a very similar way to this.
Yeah, and so for people listening that are not used to DeFi sort of terminology, the way that I would compare this to centralized exchanges and those who are experienced with derivatives is when you're trading on whether it's BitMEX, Deribit, or whatever. This is a zero-sum game where you have a pool of longs versus a pool of shorts, which are always equal. And as long as each side is properly collateralized, then the system maintains this solvency, harmony. And so if I'm thinking about it correctly, it's sort of similar in logic to this.
I would say that's mostly correct. So that's definitely correct for our Perpetual product. It is a zero-sum game, kind of like longs always equal shorts. However, that's not necessarily true for the margin product. It's not necessarily zero-sum. People are kind of all depositing and borrowing different assets. So there doesn't have to be like one unit of short for one unit of long on the margin side, because what you're effectively doing on the margin side is you're physically trading and physically settling all the assets that you're trading. These assets can be moved like off and onto Dydx at any time. And basically the entire thing works in a similar way to like BitMEX or something else like that, provided the entire system is collateralized. So it does share that property with probably other centralized exchanges that traders are used to using.
Okay, yeah, I didn't want to get hung up on the zero-sum game aspect. It was more like if I'm going long on Deribit or FTX, where there's a zero-sum game, I'm basically not longing versus a particular user who's going short, because the system can be abstracted in a pool manner where the pool of longs is trading against a pool of shorts, and you just sort of average out the risk and the collateral that way. But yeah, that makes sense that you don't have the zero-sum game aspect, but you do have this pooling of the risk for those on either side.
Yeah, that's exactly correct. And I think that's, a great analogy.
So one more thing before we get to the Perpetual product. So when the interest is being continuously paid, you said the fills have to be done on chain, but how do you walk us through like a liquidation, for example, how you're able to ensure that the interest payments, if they were to make a trader insolvent, how much is happening on chain and how much is happening on the central server when you're processing this kind of risk event, which I presume happens once in a while?
Yeah, definitely. So the way liquidations work on DYDX, but again, both for the margin product and on the Perpetual product, is they're not done by a central entity. So they don't have to be sent by us. And this is kind of to protect the decentralization of the system. So like say we went away for whatever reason, the system would still remain collateralized, like liquidations could still occur. And the way this works is once an account becomes under collateralized for whatever reason, say like the price of the assets change, the account accrues like too much interest or whatever it is, then basically anybody can send a liquidation transaction onto the chain and effectively ask to liquidate that account. And then once somebody sends this liquidation transaction, what the smart contracts will do for whatever account is being specified for liquidation is check that that account is in fact under collateralized. And the way that the smart contracts check that the account is under collateralized is they use what's called an oracle price. So what an oracle price is it's very similar to like an index price that are used on many popular derivatives exchanges, just kind of an average of the spot prices for that asset across a wide array of different exchanges. The only reason that the oracle price is different than an index price is kind of the oracle price is actually pushed onto the chain by a decentralized network of reporters, but we don't have to get too much into that. So effectively, once a liquidator has spotted kind of an underwater or under collateralized account, they'll send this liquidation transaction. Smart contract will check that it is in fact liquidatable, given the current state of the oracle prices and the balances of that account. And then if in fact everything checks out, then basically the liquidator will be able to liquidate that account at a certain premium to the oracle price. And this is currently a 5% premium that liquidators earn for liquidating underwater accounts on the margin protocol. So that's kind of their incentive to constantly be monitoring these positions, like see if any are under collateralized, because it's actually a pretty profitable opportunity if you're basically getting to be able to liquidate some of these accounts and get a 5% premium for your trouble.
So yeah, so when you say 5% premium, you don't mean like a 5% higher price, but just a 5% better price, whether it's a short or long liquidation, right?
Yeah, that's correct. It's like a 5% better price.
Yeah, and then so this compares. So I guess I've done some of these CDP liquidations on MakerDAO, and sometimes you can get like 13%. They advertise this usually as a benefit you can get from the ETH getting liquidated. So you think 5% has that been good enough to attract enough liquidity to gobble up these insolvent traders?
Yeah, definitely. So you're exactly correct. This is very similar to how liquidations work on MakerDAO and also many other DeFi platforms like Compound and things. But yes, definitely 5% has been more than enough to incentivize a really good network of decentralized liquidators to be able to come and liquidate our positions. So one, I think, really good example of this and kind of testament to this is when on Thursday, so that day, the price of like Bitcoin and ETH went down like 50% or whatever it went down.
No,
we were able to liquidate. Yeah, I'm sure. We were able to liquidate like all the positions, and kind of the 5% spread was enough to incentivize people to be able to do that. I think one of the things we focused on is we have an open source liquidator bot. So if you're interested in getting started with liquidations, potentially earning some of this premium or kind of incentivization that's paid to these liquidators, we do have like an open source liquidator bot. And this makes it really easy to get set up and start doing and kind of participating in these liquidity events when liquidations happen.
So I've done this on the MakerDAO network, and it's actually kind of a pain to be a liquidator if you don't understand at least a bit about code and how the some of the more technical side of things. How easy do you make it for you? So you say you have an open source thing about what language is it written in, or do you have any kind of UI where someone just wants to throw 1,000 ETH into it and just pick up 5% better priced liquidations? How technical does one have to be? Because I found I haven't done it on your system, but just to compare the MakerDAO one, I found it a bit difficult to do it on the MakerDAO one. How user friendly is it on yours?
Yeah, so it's not as user friendly as just having like a UI for it. So it does require at least using the command line a little bit based on how comfortable you're with that. But effectively, what we offer is we offer an open source liquidator bot, and the way you run it is through a Docker container. Docker is a very popular way to run containers. So if you have Docker, you can basically just do type in your command line like Docker pool dydx/liquidator or whatever it is, and then effectively you'll have to set some parameters to start the bot. So things like what sized accounts do you want to liquidate? Like how much collateralization do you want to minimize that for your own account? What's your private key? Like things like that. So it's not as trivial as having a UI, but it is fairly simple. What I will say is there are a lot of liquidators out there that are quite technically complex, I will say, because basically what happens for a lot of these Dydx liquidations and Maker CDP liquidations, things like that, is it effectively becomes like a gas price auction for once this account becomes under collateralized. Everybody will see that effectively, before the next block time. And then whoever's transaction gets mined first is the person that gets to actually liquidate this account. So from the health of the protocol's perspective, that's really good, because we have this network of liquidators that are all willing to liquidate accounts by paying really high gas fees. But definitely if you're trying to do liquidations, it is pretty competitive. And there are people out there that are kind of willing to pay high gas fees. Could still be like a very profitable arbitrage opportunity with the 5% spread that you're getting. But definitely there's some complexities that you will have to think about. But, we do our best to effectively offer an open source bot that we feel is pretty easy to use for anybody that's somewhat technical.
Yeah, I could imagine it would be a huge pain if you're competing with like 100 others and you're just wasting gas every single time because you didn't bid high enough in order to get included before the others. But yeah, 5% is really generous. I had a question then just before the last one before we move on to the perpetual stuff, because I know that's your new product and I think a lot of Bitcoiners here are interested to see what you're doing there. But on the MakerDAO CDP liquidations, they had auctions where people could bid 0. What happens in your system if there just aren't any bids for the liquidator from liquidators for the insolvent trader, and he's just getting hit more and more by the market? What does your system rely upon in order to maintain solvency?
Yeah, that's a great question. So our auctions do work differently than Maker auctions. So it's not possible that somebody could bid 0 on Dydx and effectively win the liquidation auction, as happened to Maker on Black Thursday. You'll basically, when you're trying to liquidate an account on Dydx, it's not really an auction. It's like basically the protocol is offering to trade with you immediately at the Oracle price plus a 5% spread that I was talking about. But you're right. Basically, like there is the case where, for whatever reason, if like the Oracle price is off or like there just isn't enough liquidity to liquidate accounts or like the price is falling like super fast, definitely possible that kind of the entire system could become under collateralized. For this reason, we have, higher collateralization ratios than you'll normally see on centralized exchanges, at least for now on our margin product. Which we feel are kind of safe given the kind of historic volatility we've seen for the assets that we offer. That being said, if there is an under collateralized account on the platform, we do have an insurance pool, which is, a similar idea to like a BitMEX insurance pool or something like that, which is all smart contract based and effectively accrues over time by taking a very small spread on the interest that's paid on the platform. And this pool can be programmatically used by anybody to recollateralize underwater accounts if they get through the liquidations without being liquidated for whatever reason.
Okay, and has this insurance fund been used for this purpose yet?
It's been used for 5 very small accounts. But it was like less than $100 total that it's been used.
Yeah, I mean, a lot of us who are trading in bigger size, we're, I think, a bit more careful not to under collateralize positions, and we try to actively avoid liquidation. So it's usually unusual. I should say it's unusual that a larger trader would be so poor in their risk management that they would lead to liquidation.
Yeah, I think that's right. Most of the accounts we see get liquidated are smaller, though it does happen for bigger accounts sometimes, I will say.
Okay, let's then finally get to the new product you guys are launching. We've already talked about how the Dydx protocol works for the spot trading, margin trading, and now we are on the perpetual futures, perpetual swap, perpetual contract, whatever people want to call it. And it's a Bitcoin versus USD Coin Contract, which is linear, and that means that you are holding an ERC20 token, the USDC, and then there's an oracle that's feeding an index price, which is marking the fair value. And so you're basically participating in a zero sum game with other traders who have USD coin, and you're taking bets on Bitcoin dollar going up or down. Is that all correct? Or do you want to add anything to this?
Yeah, that's exactly correct. And I think that's a good introduction. So what we've kind of built is very similar in terms of its execution from a trading perspective to the products that are being offered by other exchanges, like FTX, BitMEX, et cetera. Definitely, we do our collateral in a stablecoin as opposed to doing it in Bitcoin or some of the other things that different exchanges are offering. So it is a linear contract, which we feel makes it simpler to kind of trade on. And we've seen that model work well for some of the new exchanges that are offering perpetuals coming into the market. So linear contract works all through smart contracts. A lot of the mechanisms are similar to kind of some of the things that I was describing for the margin product. And kind of the main way that this is different is it is obviously a zero-sum game. There's not actually any physical Bitcoin on the platform, so all synthetic trading. And I'm sure as all of your listeners are familiar with, kind of perpetuals work by using a funding rate. And this kind of funding rate is just paid between longs and shorts based on kind of a premium as to how far off that the contract is trading from the underlying index price. So very similar to centralized exchanges, we'll use an index price of a number of different kind of the most robust centralized spot Bitcoin markets. And then this price is just fed into our smart contracts using an oracle. But I'll stop there and happy to answer any questions to kind of dive deeper into any part of the system that you're interested in.
Yeah, so similar. So basically, the funding that accrues, it's continuously being deducted from the balance, but there's nothing on chain happening. It's only once you close a position that the funding actually gets like on chain removed, like a fill.
That's effectively right. Though you can basically consider it being continuously paid on your account. It basically, you're right. Like it settles basically whenever you do any like quote action on your account, where like an action is like you making a trade or depositing or withdrawing or doing any state changing action, basically. But effectively, you're kind of continuously accruing or paying this interest. That'll show up immediately in your balances on Dydx, like on the website, where you can kind of see this accrue in real time. And then effectively, you just have to pay or receive it whenever you do your next action on your account.
Okay, so what if I have like a gigantic position and I only partially close it? Does that count as an action which leads to the entire funding due to be applied?
Um, Basically, I wouldn't like, I don't want to get too much into kind of this, like it's settled on like when you do an action. That's basically just how the smart contracts work because of some of the constraints of programming smart contracts on Ethereum. But as a trader, you can exactly conceptualize it as this funding is being paid or earned in real time. So, if you're, say, you have a huge position and you partially close like a little bit of it, that doesn't mean that you have to immediately like pay like all the funding that you would have accrued on that entire position. That funding is just being deducted or added to your accounts basically in real time on the application and on the protocol as well.
Okay, yeah, I understand where you're coming from. That UX wise, people should understand it as just deducted. It's just sort of keeping the thread with the original stuff from the beginning of the talk about non-custodial and having to sign just to create an order. I'm just sort of intellectually curious, I guess, how this funding mechanism is occurring without you having to do any signature related to it, but there's still debits and credits, sort of. That's sort of where I'm a little bit confused how that works.
Yeah, absolutely. I can dive into it a little bit more. Stop me if I'm getting too technical, but effectively, the way it works on the smart contracts is say you've deposited into your account, you have some, let's say, long position. So, kind of the smart contracts have a record that your account is long for this amount. Kind of the way the funding works is there's this basically global variable called an index. And then kind of this index is what basically tracks like the funding received or paid by longs to shorts over time. So say when you opened your position, this index, which is globally stored on the smart contract, was like 1.5. Then say that every time anybody does anything on the smart contract, this index will be updated kind of like in real time when, say, like somebody totally random just does like a deposit to their account. Like this index will be globally updated with kind of what the interest rate or kind of the funding rate was over that time, and then combined with how much time has passed. And then basically your balances are kind of what the like multiplicand of this index rate, or sorry, this index, and then basically what the balances of your accounts are. So effectively, by only having this one global variable that's always updated anytime anybody does anything, that like modifies everybody's balances at the same time without us having to, say, change the variables for each individual person's account on the smart contracts. And that's kind of why I was saying you can effectively conceptualize it as you're earning or paying interest in real time, because that's effectively how it works.
Okay, yeah, that makes sense. So from a user's perspective, in order to trade the Bitcoin dollar perpetual on Dydx, they need to get some USDC ERC20 token, deposit it to the platform, and then they can just start creating orders, signing each of the orders, getting into positions. How does it work for? So you mentioned that to avoid spam of small orders leading to a lot of different on-chain transactions, which you guys pay for. You said that on the maker side that there's like an exemption for this small order fee. So what if an evil trader, and I'm sure you thought of this already, so I hope I'm not like revealing anything bad, but what if an evil trader or an evil market maker put the minimum order size and just did like 10, 20,000 tiny orders, forcing people who want to move the price in one direction or another to basically pay a higher fee to get through the walls of tiny orders, which are spam orders?
Yeah, that's actually a great question. Yeah, and I appreciate you thinking about this critically. Definitely something we've thought about before and kind of have a couple different mitigations to basically try to prevent this. And the first one is there's just a flat maximum number of orders you can have open on the book at a single time. Of course, some attacker, let's say, could get around that by saying just placing like the maximum number of orders across a number of different accounts. So let's still like assume that there could be like a lot of small orders on the book. The way that we get around this, and kind of a small limitation that almost never like functionally matters on the exchange, but is worth noting, and it is documented on our public documentation page, is that we only will fill a maximum of 10 maker orders at a time for any fill transaction. And kind of if you say you place an order that's kind of gets through 10 of these orders, we won't fill anymore. But kind of the algorithm that we use to basically determine which 10 orders we want to fill, it's not just the first 10 orders. So it's not like, say, the first 10 orders are all just like really small orders on the book. It's not like nobody can place big trades. It's effectively, and you can read more about this on our documentation, but just at a high level, how it works is our matching algorithm will say basically take the price of your order, and then it'll continuously try to fill it up until it has 10 orders. And then if your order is still not filled, but basically there's still liquidity, there's additional orders that could fill it, we'll continue to like go up the order book in terms of best price for you, the taker. And then we'll just, if there's a bigger order, like if the next order that's not in our 10 order set is bigger than the smallest order in our 10 order set, we'll replace the smallest order in our 10 order set with like the next biggest order. A little bit complicated, but you can read more about this online. And that basically protects, the system against just locking up ever if there's, really a lot of really small orders on the platform.
Okay, that's interesting. So then in that sense, it's not a strict price time priority central limit order book, because there are cases where it could jump ahead of someone's orders if it fits into this situation.
Yeah, that's exactly correct. It's not exactly like this is probably, I would say, like the only like good thing about the exchange, and definitely try to document this and surface it while you're actually trading on the platform. Like if you're using our website, you don't have to worry about this. We'll effectively have this algorithm also coded into our front end. So if you're placing a really big order on the front end, it takes this into account, and we'll kind of display that as kind of the approximate expected price with just filling like these 10 orders on the front end. So there won't be any surprises. You can still set a limit price for yourself. So like if there's some price you don't want to trade worse at, we support like fill or kill orders. So we feel there's a number of like mitigations for this, but certainly something that if you're a very sophisticated trader, especially programmatic one on the maker side, you should be aware of.
Okay, and so you mentioned this approximation, and that's another thing I noted as I was playing around with the Bitcoin dollar perpetuals on Dydx was that some of the orders have the not a directly equal, but a approximate sign when it comes to prices and fee amounts and stuff like that. Is other than the mechanism you just described, are there other reasons why you wouldn't be able to just provide equality on some of these, especially USDC values?
Yeah, so this actually doesn't have anything to do with us being a decentralized exchange. The reason we show approximate prices is both for market orders and then crossing limit orders on the exchange. So if you place one of these two types of orders, basically your price is unknown until it hits our matching engine. And this is exactly the same property as you would get from trading on any other centralized exchange. So, if you go on, say, like Coinbase Pro, or I'm not sure exactly which other exchanges show kind of the approximate like squiggly equal sign. But if, you make a market order on Coinbase Pro, it'll show kind of the very same squiggly equal sign. And that's the reason for that is just because we don't know exactly what the price is going to be until it hits our matching engine, right? Because like say, we show you some price on the front end and that all looks good. You want to take that order. And then by the time it gets sent to our matching engine, it gets canceled before that, or the price changes or whatever. Definitely the price could change before it hits our backend. If you want to mitigate against this, you could use fill or kill limit orders where you can set your worst price on the exchange. We support setting like the maximum amount of slippage you're willing to tolerate on market orders. But functionally, the kind of the time to finality is pretty short on Dydx, and the orders can be considered final. Trades can be considered final once they hit our matching engine.
Okay, and so if I'm interested to trade the Bitcoin dollar, I have to use USDC ERC20 token on here. And what's the leverage? What's the margin requirements for a user that's trading on this?
So right now, the maximum initial leverage is 10x. So it's certainly less than centralized exchanges, though what we do see on centralized exchanges is kind of most of the volume is already concentrated, not close to like the 100x like leverage that most exchanges are offering. So we feel that we can serve like most of the users that we want to serve with kind of this amount of leverage. That being said, this is something we're looking to improve over time. And kind of the main consideration here for us being able to offer higher leverage is how accurate our Oracle prices are and kind of how fast they update. So basically, we can consider, we can ensure that all the accounts will be liquidated before the price changes too much and they become underwater. That being said, just want to reiterate that also on the perpetual side, in addition to the margin side, we do have an insurance fund. This insurance fund we've seeded with 150,000, and then it kind of grows similarly to the mechanisms for growing other centralized insurance funds. So we basically will take a certain cut of the liquidations that are going into the fund to basically grow it over time. So that fund is basically it will always be used before any accounts get deleveraged. Deleveraging, for those who aren't familiar, and this is a concept that exists on centralized exchanges as well, is basically a process where if an account is fully underwater, like it has a negative value, that account can be placed onto the account of kind of the most profitable winners of the exchange. And that's basically something that can happen on like BitMEX, other exchanges, and something that can happen on Dydx as well.
Yeah, I think people are used to this auto deleveraging risk, and on most exchanges, it's a function not just of profitability, but also how leveraged they are. So regardless of how much profit I'm in, if I have fully collateralized my position, then on most exchanges, I wouldn't get auto deleveraged. Are you using only profit? Or are you also taking the amount of margin that they are holding into account?
Yeah, I should have mentioned that, but you're correct. It works similarly to other exchanges where we'll try to, deleverage onto the most leveraged accounts on the other side.
Okay, and I think yeah, people are used to this. And how big is your insurance fund right now, back in the market?
Right now, it's 150K USDC, which we've seeded it with. It should grow over time. We may contribute more to it out of our kind of personal funds based on how much open interest there is on the contract, but something we're monitoring over time.
Yeah, I think given that it's 10x, it's not a huge risk because I guess the liquidators would still have plenty of room to step in, but it definitely necessitates having both the insurance fund and the auto deleveraging as a backstop versus the margin where the leverage. How much is the leverage on the margin? I presume it's much less.
Yeah, on the margin, the maximum leverage is 5x.
Yeah, that makes sense. So what led you guys to use USD coin? Because there's a lot of, I mean, people maybe in years past have been more used to using Bitcoin as collateral and then having this sort of goofy inverted profit function, which lets you trade a fixed amount in USD terms, but it's only Bitcoin that is being traded between counterparties. And then more recently, we've seen FTX, which has a really interesting system where you can actually put multiple forms of collateral down and they're valued in USD. And then you've got Binance and OKX, which have launched USD Tether collateralized linear futures on a variety of different things, including Bitcoin. So, what is it that led you to use USD Coin, which has like less than 10% of the market cap of Tether?
Yeah, that's a great question. Before I start on kind of our decision to add USD coin, I will say that kind of the number one feature we're working on right now, which should be live hopefully sometime in the next month or two, is enabling users to deposit USDT to the Perpetual contract in addition to USDC. Stay tuned for more details about how this will work, but I realize that kind of supporting USDT is a really important feature that we need to build for the community. So we will add this sometime in the near future. That being said, kind of our decision to start with USDC and using that as collateral, I think mostly has to do with a couple different things. So the first one is it's much easier to go from dollars in and out to USDC than it is to USDT. So that's the first reason. The second one is USDC has historically been a good bit more stable than USDC, which we feel is an important kind of thing, especially for the collateral that you're using when you're trading some of these perpetual products than USDT has been. And then I'll say kind of the final thing is we believe that USDC has a lot lower risk of kind of going insolvent or depegging from a dollar for whatever reason than USDT does, especially with some of the kind of public info that USDC has put out about collateralization, actual assets backing their coin and things like that. All that being said, totally realize that USDT is kind of the king for stablecoins right now, especially on centralized exchanges. We're really excited about the opportunity to bring that to DeFi derivatives as well.
Yeah, I think the volatility in Tether, like over a year or so ago, that's definitely. I mean, if you look back far enough, there's been significant instability. I remember buying Tether at like 85 cents on the dollar at one point. But they're despite the fact that they released this information about lending $800 million to Bitfinex, they're minting more and more coins over the past months, so that the rate at which they're not fully reserved by actual liquid dollars, it's shrinking to like maybe 5 or 6% these days, because as they're minting more of these coins, they're actually getting fresh reserves in. So that $800 million loan, I don't know what the principal is on it now. I think like 600 million or so. That's becoming a smaller percentage of the overall pie, which despite the fact that everybody has been trading it at parity anyway. Even though this loan was revealed, so and the situation is just excuse me, is getting better because they're minting more and more coin. So the rate of that non-backed percentage is getting smaller and smaller. And so I think traders are just accepting this risk, and even though they've lent these dollars out, they're collateralized by, and it's quite incestuous, admittedly, because they are collateralized with the parent company's shares. So they're one subsidiary lending to the other, collateralizing with the parent shares it is a bit goofy. But traders, I think, have assessed this risk, and it's such a utility for the overall crypto space that there's a pretty high confidence in the and Deltec is backing the percentage of the reserves which are they're sitting at Deltec, which is a lot of traders use and find to be reliable. So yeah, I think that's why it's been trading at parity, and I think despite that past volatility and despite these disclosures, traders love Tether and trust Tether because they've been around the longest.
Yeah, absolutely. And I totally accept that. We certainly, as an exchange, don't want to be too prescriptive with kind of, how we're telling people to trade. And if kind of the market's trusting Tether, which empirically it is, certainly as an exchange, we want to be able to come out and support that. Kind of the biggest consideration for us when we add Tether or, really any collateral asset to our protocol is we want to assess the risk pretty critically. Especially if it's kind of something where, say, we have like multi-collateral, and then it could affect, the Tether risk could affect users who aren't even using Tether on the platform. So definitely that's something we would think about when it comes to offering like multi-collateral for the Perpetual. People just want to use USDC and say take the other side of that argument, the other side of that coin, and they feel like USDC is more trustworthy for whatever reason. Then we don't want to expose them to Tether risk. Or conversely, if you want to use USDT, we don't want to expose you to USDC risk or kind of like the any other risk for any other asset that you're not trading. So that's kind of the main consideration for us. That's kind of why I was saying we're really excited about adding Tether support in the near future. Not exactly sure how we're going to add it yet. There are kind of a couple different options for what we're considering and kind of the product way we're thinking of adding it. But we believe that we can make quite a good user experience for people onboarding to our Perpetual just from having Tether themselves.
I think that would be interesting. I don't know how popular Tether is in DeFi, but I could think of a couple of ways where that would be accommodated. Like maybe by using Tether collateral to borrow USDC or something like that. So there's and I think it's fair that you would make the decision to go with USDC. But is the index actually USD or USDC based from the spot market?
It's USD based. But effectively, if the protocol is single collateral, it doesn't actually matter for kind of the health of the system. Everybody's profits or losses will basically just be multiplied by kind of what the ratio of USDC to USD is. Given that we feel, given that Coinbase is offering one-to-one USD to USDC conversions for anybody that has a Coinbase account, that it should be pretty close to $1 for anybody who has access to, getting dollars out of Coinbase. But certainly is something that you might consider if you're, say, an overseas trader that doesn't necessarily have access to that functionality.
Yeah, I mean, definitely the convertibility window for USDC is way more reliable than USDT. Despite all of the declarations they make of having the funds at Deltec and all this stuff, it's still a pain in the ass. There's definitely frictions there. But strictly speaking, if it's a USD index, and you're using USD collateral, then it's sort of a quantum because the multiplier then, even though the harmony in the system is the same, your collateral is varying from what the quote currency is for the index. So in strict terms, it's quantum, right?
Yeah, that's correct. It technically is.
Yeah, okay. That's my autistic sort of point to make. Okay, so we've gone over everything from you need to use USDC as it is now. You're looking for a Tether solution to integrate to it. But right now, anyone that wants to trade Bitcoin versus dollar can acquire USDC. And when I was doing it to test, I actually just used this thing called Uniswap to get USDC. I thought it was the easiest way to do it. It wasn't too high of a transaction fee, I guess, but just to easily grab some USDC. And then, but I guess you could use DYDX, right? I didn't think of that, but you could use DYDX spot market to deposit ETH or some other asset and then switch that into USDC, right?
Yeah, that's correct. Right now, you can switch that for USDC. As I've been mentioning, we're going to come out with a really easy way to convert USDT to USDC in the near future, which we imagine should be really liquid and not make you incur too much slippage or anything like that before you can use the Perpetual product.
Okay, yeah, but it's just that that's the one thing that's required before trading the Bitcoin dollars, that you actually need to have USDC. So one way or another, if you're interfacing with Ethereum as a trader, you need to get into USDC and then deposit that into DYDX, and then you're in the game. You can just trade with others 10 times leverage. And then so the funding payout, are you doing an average of the mid price versus the index, or how is it that you're calculating that rate?
Yeah, absolutely. So we put quite a lot of thought into this. There's tons and tons of documentation on this on our docs page. So I would very much encourage you or anyone interested to check that out if you're interested in diving deeper. But at a very high level, we actually, it's a bit more complicated than just taking the mid-market price as kind of for calculating the premiums. So right now we take the impact price. So this is a similar thing to what BitMEX and I believe a number of other exchanges do, where they'll kind of eat into the order book like a certain amount of depth and use that to calculate like the mid price rather than just taking like the actual like traditional mid-market price. And the reason people do that is to basically make that price a little bit, a good bit harder to influence. That being said, basically what we do is we'll calculate the premium once every minute, and this is calculated at a random time on that minute, again, to protect against kind of people messing with the price when we're sampling it. We'll take the price of the order book every minute, and then once every hour, we'll send an update onto the chain, which will actually update the index price. So the index price is updated every hour, once on the hour, exactly. And then basically that price will go into effect immediately. You can kind of see on the application like what the next index price will be before it's actually updated. And that's basically how the system works. Tons more documentation in a lot of detail about this on our docs page for anyone who's interested in checking it out as well.
Okay, so hold on. You said it's only updated once every hour. Is this the same index that's used to mark the fair value of the position to determine liquidation?
No. This is a totally separate. This is a totally separate price. So this is just for the funding rate, and it doesn't have anything to do with kind of the index price or the Oracle price that's used for liquidations. That's updated much more frequently.
Okay, how frequently is that?
Right now, so we kind of plug into an Oracle system that we don't necessarily control, and that's by design. So we plug into the MakerDAO V2 Bitcoin Oracle, and this kind of Oracle system was built by MakerDAO. Again, you can see more info about this on our webpage. But basically, the way that system works is anybody can kind of send updates to the chain. Sorry, taking a step back, there's kind of a decentralized network of reporters, which will all report the price of different exchanges. So things like the Coinbase price. Sorry, I forget off the top of my head like what other exchanges are included in the index price. But right, yeah, like Bitstamp, I think, Kraken maybe. Anyways, there's like 5 of the most reputable like centralized exchanges, and then there's a decentralized network of people that are reporting effectively what the price of Bitcoin is on all these different exchanges. So people are reporting these. They're not actually sending transactions to the blockchain. They're actually just cryptographically signing messages. Kind of a similar idea as the thing I was talking about for people just signing orders on DYDX. So there's decentralized network of people that are reporting these prices. They're like sending out these like cryptographically signed messages. Then anybody can basically go and send these messages onto the chain to update the Oracle price whenever they want to. There are a couple of centralized people that are doing this and have certain SLAs on how frequently they're updating the Oracle. The first of which is MakerDAO themselves. I got to check in terms of like what their current SLA is, but I believe it's like either once every hour, or if the price moves by like more than, don't quote me on this, but I think it's like 0.5% or something like that. Similarly, we as like centralized DYDX are also sending these Oracle updates either, I believe, again, like once every hour, or if the price moves by more than 0.5%. And then there are a couple other people doing it as well. So it's basically like the Oracle will be updated very soon after the price moves by more than a certain threshold, which I believe is currently 0.5%.
Okay, so this Oracle system is basically the replacement for what centralized traders on centralized exchanges are used to, where it's just basically the equivalent of if your centralized server on Dydx was to pull the index component data yourself and do some computation and stream it over WebSocket, you're actually sourcing this number from an Oracle system from MakerDAO.
Yeah, that's exactly correct. We don't. So there are two ways in which we use this Oracle price. So for on-chain liquidations, we use the on-chain price. But for funding rate calculations, we use the real-time price. So for the funding rate calculations, we'll actually just on our centralized servers, not through the decentralized maker network, we'll query all those different exchanges to get the price ourselves. And the reason we do that for the index rate calculations, the funding rate calculation, is just because it's lower latency. So we can get like a better picture of what the price is sooner and apply that to our funding rate sooner.
Okay, that makes sense. So it's essentially a centralized experience through a hybrid DEX system that you've established here. So we've already covered all the stuff from the risk management side with the liquidators and the insurance fund and ADL if it's necessary, and they can trade up to 10x, which most responsible traders don't use more than 10x really. So I don't think many people would be discouraged by this. And the fees, I think that's one thing where we touched briefly on it when talking about the margin product. But can you tell us what the taker and maker fees are for the Perpetual contract?
Definitely. So on the Perpetual contract, it's for normal orders, so orders that are over the small size limit, it's 7.5 bips on the taker side, and then 2.5 bips rebate on the maker side.
Okay, so BitMEX's fees. And what's the small order limit?
I'm pretty sure it's 0.02 BTC. It's kind of targeted at like around like $1,000 or so.
Okay, and are you at all concerned about this network congestion on Ethereum, where does it threaten your business model in the fact that you're paying for all the fills that are being pushed on chain?
Yeah, absolutely. Definitely something we think about a lot. Like clearly, if we see, in order of magnitude, more trades being put through the system, which, as a venture-backed like growth company, certainly we want to get to that point. We'll definitely have to confront that at some point. Kind of our focus or kind of our approach to scalability so far has been to first focus on building a really excellent product, like something that people actually want to use in a really big way. And then next, think about the best way to scale it. So as I've been saying, like certainly it doesn't make sense for us like in perpetuity to send one fill transaction per one trade onto the blockchain, at least onto like Ethereum's layer 1 blockchain. So certainly we would be like a really early adopter of some of these interesting scaling solutions that are out there. Not to get too much into it at this point, but some of the interesting things I'm personally excited about are optimistic rollups, and then ZK or zero knowledge rollups, and how those could potentially be applied to a kind of trading or derivative system like Dydx. So yeah, would be early adopters of those. No firm plans at this point, mostly in the research phase, but we are definitely looking to have something implemented and something working on the scalability side. At least, I would say maybe in like a year or so. We'll see what happens. Effectively, traders on Dydx don't have to think about this too much. It's more like a question for us as kind of like a business and kind of our long-term profitability. Luckily, we are pretty well capitalized at this point. And even right now, we're definitely making a lot more in trading fees than we're paying out in gas fees, which has been good for us. But that's why we kind of have to push the trading activity that's happening on Dydx towards larger orders. And to this point, that's mostly been like the target users that have been using Dydx anyways, have been more of these like whale type users. One interesting statistic about Dydx, and I don't have the latest numbers on this, but we've seen like the average trade size on Dydx, even before we had any transaction fees. So like even before we had the small order size or anything like that, it was over $6,000 just on our margin product. So that's like way higher than what like any centralized exchanges that are popular really see. So definitely we're kind of building a product that's really catered towards some of these more advanced, some of these more whale type users who are putting through these bigger trades. So it, kind of our scalability plans mesh really well with that. So it's been good for us so far.
Yeah, that sounds good. And also, I think it's good you've kept the team small. I think you said 9 members total. I think a lot of startups get a bit caught up when they get some money and they start spending on unnecessary, fluff team members, which aren't really helping much. So I think it's good you've kept pretty lean in that regard. What about, so you're talking about, so you're obviously paying attention to the scalability stuff, and I was going to ask about ZK rollups, so you already mentioned it. I think a lot of the Ethereum people that we've been talking to this month, because it's Ethereum month at Whalepool, so we've been trying to understand the scaling issues, the centralization issues on Ethereum, and also, of course, ETH 2.0. So how are you preparing as a business on Ethereum? How are you preparing for ETH 2.0? And as I understand it, and as I'm still, we've been spending a couple of weeks talking to Ethereum people, but I'm still far from an expert on this. But my understanding is on one of the phases for Ethereum 2.0, you have to choose a shard if you're a project, if you're migrating over to the Beacon proof of stake chain. How much are you guys spending in terms of time and resources in preparing for ETH 2.0? And do you think it will help on a lot of the scalability side of things?
Yeah, that's a good question. And take what I say on this with a grain of salt, because I'm a little bit opinionated and certainly other people have different opinions. But currently we're not spending any effort in terms of like trying to figure out what we should do for ETH 2.0. So as you're probably aware, ETH 2.0 has a lot of different phases. I don't even know, it keeps changing all the time, but there's like 7 phases or something like that.
And I've heard 3.
3? Oh, okay. It used to be 9, so I don't even know what kind of the current plan is anymore. So anyways, that kind of brings me to the first, I would say, annoyance as kind of a Ethereum application developer in terms of Ethereum 2.0. It's very difficult to understand even like what the plan is for kind of people implementing ETH 2.0. And my interpretation is kind of the final phases are still somewhat in the research phase. So it's not even kind of fully fleshed out what exactly they're going to build yet. That being said, there are like good strides being made to like start implementing ETH 2.0. I think like phase 0 is going onto mainnet sometime this year, I think, which is good. But realistically, like as like an application on Ethereum, my like odds on bet for like when Ethereum 2.0 will provide any benefit to decentralized applications being built on top is I don't think it'll provide any benefit before at least 3 years from now. That's just kind of my personal opinion. I would be thrilled if it could provide some benefit to us or other decentralized applications before that. So very happy to be proven wrong. But just kind of realistically, that's kind of like the timeline, or potentially even longer than that, for when I think we'll have decentralized applications see any benefit from specifically ETH 2.0. And that's kind of why we're interested in really seriously exploring some of these more like actually production ready scaling solutions. So things like optimistic rollups are being used right now in certain decentralized applications, like zero knowledge proofs are being used as scalability right now with existing Ethereum. So those are kind of more the types of things that we're interested in probably using sometime in the next year or so to address some of our scalability needs.
Yeah, I think that's interesting, your opinion on ETH 2.0 and scalability, because what I've noticed this month in talking to tons of different people on in the Ethereum community, and I'm only sort of tangentially been involved with Ethereum. I've obviously been a speculator on it and been involved in a couple of interesting projects with Ethereum, but I would say I'm a Bitcoiner when it comes down to it, and most people here are more interested in speculating when it comes to non-Bitcoin coins. But I think it's what I've found interesting is that there's almost like a level of cynicism in the Ethereum community about ETH 2.0, and a lot of people find it difficult to understand. Some people are super pumped about it and they can't wait to stake as soon as it's available. Others are just sort of, yeah, okay, we'll believe it when we see it. So there's quite a diverse set of opinions I've noticed on ETH 2.0, and I think you're firmly in like the realist camp where you're focused on the here and now or in the short to medium term, and not so much on betting on things happening further down the line where it's a bit more uncertain. You'd rather you work with what's already available.
Yeah, I definitely think that's accurate. And functionally, we kind of have to be as like a actual business that's operating on top of Ethereum right now. And it's not like the kind of case where we can stand to sit around for a long time, or even just make like a really big bet on like a technology that's extremely untested. Certainly, as I've been mentioning, we're likely to be very early adopters of some of these new scaling solutions that are coming out. But we need a solution like probably in the next like year or two. Or DYDX is, assuming we grow at the rate we want to, DYDX is not going to work anymore. So we got to figure it out before then.
Yeah, I think that's a healthy mentality. So, so before we end this, I've had you here now for about an hour and a half, and we appreciate your time. But let's hear what you guys have planned outside of looking into these scalability things. Give us an idea product-wise. You have this system where you're pledging USDC in order to trade Bitcoin dollar, and this could be abstracted to any number of products which are quoted in dollar. It could be oil, potentially. It could be foreign exchange pairs. It could be other coins or indices traded in US dollar terms. So what can we look forward to those who are trading on DYDX on Ethereum? What sort of products do you have in line after this Bitcoin dollar perpetual?
Yeah, absolutely. So I mentioned that we're adding Tether support. That's kind of our biggest near-term thing, both through the perpetual and probably the spot product as well. So that's probably the biggest thing in the near future. In terms of the like medium, like 6 to 12 month future, definitely it will involve in a big way launching launching perpetuals for other assets besides just Bitcoin. Though on that, I will say kind of our focus on our thesis at DYDX so far has been that it's better for us to focus on kind of just the highest value and kind of highest quality, highest liquidity, highest trading volume markets than it is to necessarily capture kind of like the long tail of all the random coins people are trading. Though we certainly want to move more into that over time. We see the perpetual as a really good way for us to do that. Obviously, with perpetual, all we basically need is kind of like an oracle price, like feeding in the price of whatever asset we want to trade. So certainly expect us to be more active in terms of adding other markets than we historically have been on just the margin trading side. So no concrete details in terms of what these assets will be. Like probably we'll add like an Ethereum perpetual at some point. Potentially, don't hold me to this, but like other assets we're looking at are like Chainlink perpetual, other potentially ERC20 tokens or like bigger coins people are interested in. We're certainly keeping an eye on all of that. In terms of like more real world assets and kind of crypto perpetuals for those, something we're interested in. No firm plans to do that at this point. Definitely keeping an eye on what other kind of pioneering exchanges like FTX and people like that are doing in that space, and think it's really interesting. So we may do that in kind of the longer term future. And then kind of the final longer term feature that we're working on is other types of derivatives on cryptocurrency. So it's really interested in seeing the growth that's going on with like options on cryptocurrency. This especially has become like fairly big, especially in DeFi in the past month or two. And obviously with exchanges like Deribit has had it for a while, FTX starting to add it, keeping an eye on what's going on there, potentially adding like dated futures. And in general, we just want to add kind of the highest volume, let's say like advanced trading products that we can to DYDX, and are keeping an eye on the market more broadly to figure out what exactly we want to add next.
Yeah, it sounds good. And I think the fixed maturity, those traditional futures, they don't bring as much volume as perpetual when you look at the data on some of the exchanges which offer both. But I think it's good that you're thinking just about what's popular first, rather than catering to sort of niche markets, which it might. I think it's very difficult, and people who haven't worked with exchanges on this side of things probably don't appreciate it so much. But you can have like the most creative and best idea for some product, but if you don't have liquidity and market makers that are actually providing orders so that people can come in and trade, you don't really have a product. And so it's important to have something that's viable in that end. And so I would also ask, how is it that you're, aside from the maker rebates, how are you incentivizing market makers to ensure that there is liquidity in the market?
Yeah, so first of all, I completely agree with you, like absolutely 100% on that. Markets have to have liquidity to be impactful. So that's something we think about quite a lot. So as you'll notice, even though we launched literally 4 days ago, there's a good amount, I would say, of liquidity on our Perpetual right now, and we're looking to scale that up over time as well. So obviously, kind of first incentive for providing liquidity on the exchange is the maker rebate. That being said, we do work on a one-to-one kind of more professional like BD basis with a number of different market makers who both provide quotes on kind of our margin product and our perpetual product, always looking to meet more. So if you're interested in potentially providing liquidity on our perpetual or anything else that Dydx offers, would be happy to talk with you. We do, kind of incentivize market makers in other ways. One way we found that's pretty impactful is giving loans to market makers, just so they don't have to incur a certain cost of capital to start quoting on the exchange. Again, we're pretty fortunate to be well capitalized, so we're in a good position to do that, and we found that works pretty well. And then also potentially giving, some more like one-off fee rate deals based off of kind of the level of liquidity and service people are able to provide. But definitely that's something we're interested in, really focused on building liquidity for our new markets. So really interested in kind of working with individual people there and firms as well.
Cool. So one more question before we close out. So I'm struggling to understand the relationship with the 0x, and if you guys have, you mentioned you got VC capital, but did you guys do like an ICO or any token thing, or what's going on there?
Yeah, that's a good question. So Dydx is different than kind of most other DeFi protocols that you'll see out there. Like pretty much everybody at this point has like a token or something. Dydx does not have a token right now, despite we actually launched in kind of the midst of the ICO boom back in 2017. So for me, I guess as personally as a founder, it was like a really big question as to whether we added a token or did an ICO at that point. So it would have been like super, honestly, like free way to like raise capital, because like totally random projects, as probably all you guys know, were like easily raising like $20 million or so. And I think at that time we had already like raised a seed round from like Andreessen Horowitz, Polychain, like all these other people. So I think we were well positioned to potentially do a token, but we decided not to. And the reason that we decided not to at that time was we really didn't want to force like an unnecessary token into our protocol and kind of really hamper the user experience, or kind of like take capital from just individual investors before the product were really ready to support it. And kind of the thing we've really been focused on at Dydx is just building the best possible product. And I think we've really done a lot in terms of just pushing like DeFi more towards the user experience that traders are used to experiencing on centralized exchanges. And as you've kind of talked about and mentioned, certainly we're not 100% of the way there yet. Like you still have to sign messages and stuff like that, which is a bit of a strange experience, but I think we're getting there. Anyways, we are potentially interested in having a token at some point, though certainly no firm plans right now. I will say, kind of give you my thesis on tokens. I think there are a number of interesting token models that actually make sense. And I think Dydx is well positioned to execute on pretty much all of them. The first one, I think, is just kind of like the exchange token model. So using that for things like growth initiatives, like growth hacking, like, BNB, like pay your fees in BNB. They do a lot of like random like trading competitions and stuff like that. That would certainly be helpful for us to just effectively to kind of grow like the top of the funnel in terms of new users who are coming and using Dydx, and also kind of retaining users over time. Then kind of the second way I found that tokens are actually useful is for collateral of last resort. So for those who aren't familiar, this kind of model was pioneered by MakerDAO with their MKR token. And effectively how that token works is if the system ever becomes under collateralized, they just auction off more MKR to kind of re-collateralize the system. So kind of the token holders are effectively acting as collateral of last resort. This would be super useful for Dydx too, right? Because if the protocol ever became under collateralized for whatever reason, then we'd be in a position to have a mechanism to re-collateralize it. So I think that's the second way. And then kind of the third way, and I'm sure you guys have heard a lot about this, is just for governance. Certainly that's something we're interested in at Dydx as well, kind of fully decentralized governance. We're not there yet and are really interested in keeping an eye on what really good other projects in the space are doing. So people like MakerDAO with their governance, protocols like Compound, et cetera. But I think we are well positioned to potentially do a token, but that's kind of why we haven't done one and how we would potentially think about doing one in the future. But just we'll kind of end and really want to stress that at Dydx, our absolute number one focus is kind of on building like the best possible product. And that's something we're excited to iterate on new users with, and always we're improving over time as well. So if you don't see a feature that exists on Dydx right now, but you want it to be added or think something could be improved, like reach out to us. We're absolutely happy to chat with you anytime. And we just want to make the exchange like the best possible experience for traders.
Yeah, I think that there's some good points you raised there about tokens. And I guess two things I would say to that. One is on the exchange token front. Another, in addition to the fee discount incentives and other like giveaway type incentives, is also the buy and burn features, where essentially token holders get get a first whack at revenue before even investors do. In the cases of like Leo and FTT, which is FTX's, and a couple of others, where they'll actually take X% of revenue and dedicate it to buying up the token and burning. Obviously, your investors wouldn't be too happy about that because they basically get shafted, and you can see that in the Leo token. So I'm a Bitfinex shareholder. I haven't seen a dividend in probably a couple of years or so, because they've had to do this Leo mechanism where they're spending 20 or so percent buying up these tokens, and so they're taking money away from potential shareholders, which would be getting retained earnings paid out to them. And then the other thing about the decentralized governance, I'm pretty skeptical about this. I haven't seen super well-behaved models of this. And again, it's a situation which might disempower your investors in favor of just the masses, I guess, who are involved in the token. But I guess you can mitigate that by sort of giving them preferential access to whatever tokens released. And in both cases, I guess you'll be able to do that. But I kind of share the sentiment of, I think it was Mike Novogratz recently, who's just sick of all the shitcoins out there and just doesn't think that every use case requires a different blockchain or a different token. And it's just, you get sort of drowning in all of these shitcoins. And after a while, I think people get sick of it and they just want to stick to a few. And one of the other guys we had on from Ethereum was, I think it was Eric from ETH Hub and Gnosis, was saying that Ethereum is sort of just trying to carve out this identity as the proof of stake coin and sort of conceding proof of work to Bitcoin, which I think is an interesting value model of in the crypto space where there's so many different shitcoins out there. I'm not sure how you view that or how much you are into Bitcoin versus Ethereum, or how you see some of these competing things like Tezos or EOS or whatnot versus Ethereum. But maybe you have something to say about that.
Yeah, so first on your kind of point about like the buy and burn model, certainly think that's interesting. A lot of things to think about there as well. One thing I will say is, again, why we would be like well positioned to do this is that all of our trading fees are already on chain. They're already auditable. We could literally program into the smart contract. I'm not saying we're going to do this, but like if we wanted to, that like some like portion of the trading fees like would provably have to be used for kind of buying back like the token or something like that. So again, I think we'd be well positioned to do that. We're already taking trading fees. So again, people are willing to use our product and pay a fee for it. Then yeah, definitely in terms of like all the like random coins, I would definitely say I'm kind of more like maximalist in terms of like that there should be just like a smaller amount of coins. And then kind of as I was saying before, I really think that like the best way to build like an application level decentralized protocol. And what I mean by that is somebody that like actually offers like a real end user product. So not like Ethereum or Bitcoin or something like that. I really think the best way to build that and capture value on it is to literally build it first, and then like capture value on it, whether that's through like trading fees or like through revenue or something. But first of all, you've got to build a product that people are actually using. That's a really hard thing to do. That's kind of what we've been focused on. And I really think that all teams should focus on that before just randomly ICOing and then trying to like force their token that they have into like all these other new things that they theoretically might build or even functionally have built, but maybe haven't grown yet in the future.
Yeah, I think that's a healthy way to look at it. Shows that there's some value. Build it, and then if there is value, don't try to jam the token model into it. But if there is something that makes sense, then consider from there. Okay, I think we covered basically all of the stuff that I had. Is anyone that's currently listening, Rich, or anyone have any questions for Antonio before we let him go? He spent now over. Okay, he just tuned in. If anyone else listening wants to, I think we covered a shitload in the past hour and a half or a little bit more. So maybe no one has anything, but I just want to give a chance in case anyone who's been listening this time live has a question before we let him go. Okay, good. I'll take that as a sign that we covered pretty much everything. So thanks a lot for coming on Whalepool, Antonio. Before you go, could you tell us where we can get in touch with Dydx? So, you said to reach out to you if we had any feedback. So where can we find you guys on different social media and just the basics of getting on Dydx?
Yeah, absolutely. So our website is dydx.exchange. So just go there, has links to all of our stuff. Kind of the main place where you can chat with us live is in our Telegram group. So we have on Telegram, you can chat with us at any time. So feel free to reach out to us there. Check out the product. One really cool thing about decentralized exchanges, as I was mentioning before, is it's really easy to onboard. Like literally, if you have a wallet, just like open up the thing and start using it immediately. So would really encourage everyone to just kind of use the product, and feel free to reach out to us if you have any questions, feature suggestions, bugs you find, really anything. We just wanted to make the product, again, as best for kind of you, the traders. But again, yeah, really thanks. Really appreciate all the excellent questions. Appreciate it, you kind of delving deep into all the different parts of Dydx. Hopefully this was helpful for everyone listening. And again, feel free to reach out if you'd ever like to chat or have additional questions. So thanks so much for having me on. Really appreciate it.
Yeah, perfect. I found it very easy to get started. I just use MetaMask, and if you have ETH or any other kind of asset on Ethereum, you basically can jump on Dydx, swap into whatever relevant collateral you want, and jump into, for USDC, you just jump into that and get started trading Bitcoin. So I found it pretty, aside from the stuff that we talked about before, I found it very easy to onboard, at least, which is one of the huge advantages of DEXs in general, is that you don't have to provide an email or any of that stuff. You just jump in with the wallet. So thanks again for coming on. I really appreciate it, Antonio.
Yeah, thanks so much for having me.